There's only been one other time in 60 years that we've seen interest rates go up this much as the Fed, or long-term yields, I should say, as the Fed has been cutting its funds rate. That was 1981.
Yeah.
That was the period when the funds rate was 20%. Yeah, it was 20%. And the Fed in May of 81 started to cut that rate. And the bond market didn't like it. And it took 10-year yields to 16%. Yes, they went to 16%. And Ed Yardeni coined the term bond market vigilantes. Why did he coin that term? Because what he was saying was the bond market was saying to the Fed, we want you to be worried about inflation. And if you're going to cut interest rates, it says you're not serious about inflation. I don't want anything to do with your bonds. I sell bonds, the price goes down, yields go up. That is the bond market vigilante walking away from the bond market. I think there's a version of that going on right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Despite the confidence Federal Reserve Chair Jerome Powell is doing his best to project, inflation has not yet been slain. And today's guest expert, Jim Bianco, founder of market research firm Bianco Research, thinks it's going to continue to prove problematic. We'll talk about his reasons why, as well as his concerns about the current extreme valuations in stocks and why, if they experience a material correction, bonds may not provide the protection to portfolios that they did in the past. Jim, thanks so much for joining us today.
Thanks for having me, Adam.
Hey, Jim, it's been far too long since we've been able to chat live like this. Thanks so much for coming on the program. Happy early new year. A lot's already happened in the first two weeks of this year. It's a little bit crazy. So I've got so much to ask you about here that we're going to just plow through as much as we can in the time we have. If we can, let me start just by asking you the general question I like to kick these discussions off with. What's your current assessment of the global economy and financial markets?
Bifurcated on the global economy. The U.S. economy seems to be doing very well, and I think it might be poised to do even better, but that brings in issues onto itself. In other words, we've been seeing the U.S. at the top line growing at its potential of about 2 to 2.5%, if not more. We've got the Trump administration coming in before the end of the month, and they're going to probably bring with them an extension of tax cuts, deregulation, tariffs, which would all be stimulative, which will push the economy even faster. Well, that sounds great. What's the downside on that? Inflation. Inflation is the downside on that. And what's being really augmenting that inflation story is the Federal Reserve is cutting interest rates at the same time, which is why I think you've seen the rejection of that policy with rising bond yields. Now, about the rest of the world, it's not so good. The Chinese economy, let's start with that, which is arguably the second largest economy, is in a world of hurt. Their GDP growth rates, if you believe what the government is putting out, is about under 5%. There's only been 2 other times in the last 50 years it's been growing at that level or worse. Remember, they're a high growth economy and they're a bunch of commies giving you data, so they probably put their thumb on the scale too. But yet they're telling you it's the second lowest number in the last 50 years. Only COVID and Tiananmen Square were lower. So take and measure it against itself, they're not in a very good spot. In September, it seemed like they hit the panic button and were announcing like a stimulus program a day to try and stimulate their economy to move forward. It produced a bunch of hedge fund managers to get all excited to rush into Chinese stocks, but then that peaked about a week after the stimulus programs ended, and their stock market's falling back down to earth, and their bond yields are plunging to all-time lows as an indication or a market signal their economy is not in very good shape. If you look at Europe, Europe is upside down. The sick man of Europe right now is Germany. Germany is in a terrible position. Their economy is awful. The reason that their economy is terrible is what has been the big German economic engine of the last generation? Manufacturing. What has been the advantage that Germany has had in manufacturing? Cheap energy from Russia. The gas lines, the Gazproms that are putting it on the Nord Stream, that are sending them ever amounts of cheap energy. If you're a manufacturer, What makes you competitive to everybody else? One of two things. You've got cheap energy because all manufacturing is about energy inputs to make something, and or you have cheap labor. Well, Germany had very cheap energy from Russia. That ended with the Ukraine war. And now their energy prices or their energy expense is going up and up, and they're not having a good place to compete. And their economy is in a world of hurt. They're probably the weakest growing economy right now. What they could use is very low interest rates. But because they've shackled themselves to one central bank, the ECB, with 17 other European economies, they're not getting low interest rates. They're getting interest rates that are actually staying elevated. So it's really hurting them. Now, if Germany's the sick man of Europe, who's the strong man of Europe? Right now, the leader of Europe might be Giorgia Meloni in Italy.
Mhm.
And I think I should just stop there and say, if I'm telling you that Italy is the leader of Europe, you could tell that they're in a world of trouble. And we're
I
not
was
talking about
actually about to
food.
make that same joke. Yeah, exactly.
Yes, we're not talking about food here. Yeah, exactly. So, so to conclude, the US is doing good, maybe too good, where the rest of the world is not doing so well. And I'll just throw in one other one real quick, Japan. And Japan's economy is struggling, but it's attempting to try and recover. Their interest rates are rising, their stock market is going up because there is a hope that they'll recover. But for right now, it seems to be struggling. And what's interesting about that is there's four major manufacturers in the world: the United States, China, Japan, and Germany. The United States is doing well. The other three manufacturers, China, Japan, and Germany, are not. So we are, kind of what's kind of propping up the rest of the world's economic growth.
Okay, so US looks good. Not even cleanest dirty shirt. I hear you sort of saying it's a pretty clean shirt, economically speaking. Markets. Now we're coming into this year with markets, they've cooled off a little bit from their highs, but still on most valuation metrics, they're pretty darn stretched. So what do you think about the markets?
Well, usually markets reflect some kind of a reality and they kind of overdo it, right? So if you look at the US stock market, by almost any measure, it's fully valued, if not richly valued. Stock market cap to GDP is over 200%, which is not quite an all-time high. The all-time high was in the fourth quarter of 2021 before the big sell-off in 22. Forward earnings measures. This is Wall Street's estimate of what 2025 earnings are going to be divided by the stock market. It's in the low 20s. That's a very rich number. The CAPE ratio, the Schiller, the Bob Schiller long-term PE ratios at 38, 37, 38. That's one of the highest numbers we've ever seen. So why is the stock market so richly valued? It doesn't happen out of, randomness. It happens because of the US economy is the strong part in the world. It is growing very strong. We've got the Magnificent Seven stocks at the leading edge of what may be the next great technological revolution in artificial intelligence. Maybe it's as big as the internet itself. All of that might be true. And all of that very well could be true. That's why you get 38 on the PE ratio for
Hmm.
Case Shiller and 200% on market cap to GDP. So the stock market is very, very richly valued. Now, a quick word about valuation. It's always said, well, valuation is not a timing tool. Well, it was never intended to be a timing tool. And that's kind of a straw man that no one ever said it was. It's an expectations tool. 2013, Bob Schiller of Case Shiller of the CAPE ratio, he won the Nobel Prize in Economics precisely for saying that the higher the valuation of a market, the lower the future expected returns. If you buy richly valued markets, you're going to see much lower expected returns. And that's what we're seeing. The chart you put up on the screen shows some of that as well, too. It shows the forward PE ratio on the right, on the left for the next year. So when the stock market's richly valued, what is the next year's return? Looks like a shotgun blast. It's all over the place, and that green strip is where we're at right now. But if you look at it over the next 10 years, which is on the right, that is a much higher correlated relationship. And it shows you right now that the returns in the stock market might be in the low single digits, low to mid single digits over the next decade or so. Last thought on this. I mean, but we're going to have self-driving cars and we're going to have artificial intelligence and robotics, and it's going to be a transformational technology as important as the internet. I completely agree. It will be. It's already priced in. You need to tell me we're going to have all of that and something even wonderful on top of that that we haven't even thought of in order to get stock prices to continue to advance at a heady clip. All of that, technological advance is already in the price. That's why when you buy richly valued equities or look at richly valued markets, you wind up seeing that that they might be right in terms of what they're looking at, but yet it's already in the price. A good example of that is 99, right? Everything we thought about the internet was priced into the stock market by 99. It wasn't until about 2012 or 2013 that the market completely recovered from that 99 peak, and every promise of the internet was fulfilled in those 12 years.
So do you think it's more likely to prove like the dot-com era, where we just pulled too much of tomorrow's valuation into today, and there needed to be a repricing until the internet actually did manifest and provide the value that we thought it might? It just took a decade or two longer.
Yeah, I think so. I think that that might be the case, but at this point, it's not as overdone as the 99.com era. So you could experience, and I'm talking about over the next several years here, you could experience a lot of volatility in the market, and you could experience maybe when everything is said and done, a low single digit return, 5, 6, 7% compounded per annum from, the broad averages. I would also argue too that kind of like the dot-com era and after the dot-com era, like the late 90s and early 2000s, stock picking actually worked during that period. And I think that we're rotating back to a period that stock picking or sector picking or thematic ideas, whichever you want to call it, would actually start to work again, where we've been in a period where it doesn't work, meaning you can't beat the index. Just buy some broad-based index of all stocks and let the rising tide lift all the boats. That we've already got the tide as high as we can, and now we've got to be a little bit more selective. Now, the only caveat I'll give you on that is most professional managers will nod wildly in agreement. Yes, 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 yes. Stock picking is coming back. Problem is, most professional managers have never had to do it for most of their career
Hmm.
because we've been in this rising tide lifts all boats. That it's a skill set that not many have right now, and we'll see how fast they can learn it, and we'll see how many of the old timers that used to have it can remember what that skill set was all about.
So it's very interesting that you've said that, and I want to underscore it because you're not the first person on this program, and quite recently we've had a number of experts on the program make a similar statement that they think that, look, active management is probably likely going to be the path to success more going forward than passive. Very important point you've made, though, which is that the passive trade has worked for so long that if you look at the population of capital managers, many of them have never seen a period where active management worked, right? They don't have that musculature, right?
Or openly disdained it, that you just need to buy low cost, index funds.
Right. Time in the market will take you in the long run. Don't worry, the Fed's got your back, all that stuff. The other thing I'd really underscore here is that not only does probably the majority of the embedded base of capital managers not have the right musculature for this, but in many ways, this passive era has been the easy era of investing, right? Just buy and hold. And the only thing you have to be active about is if there's a dip, buy it, right? And so a lot of individuals, DIY investors, have said, well, I can do that, right? I don't need to pay somebody to do that. And to a large extent, many of them have been rewarded, for big, long stretches here. So you have a lot of people who potentially, if you're right, Dave, DIY wise, might be walking into this new era completely unprepared, completely with the wrong playbook, right? Is that a concern of yours?
Yeah, it is a concern. And then there's another concern I want to throw at you. And this comes from my, good buddy Rosie, Dave Rosenberg of
Hmm.
Rosenberg Research. 80% of equities, according to a Federal Reserve study, are owned by people over the age of 55. 30%, maybe 35% are owned by people over the age of 70. I've often argued that a bear market is time, not price. And if we're going to go into an elongated period of very slow returns and maybe even a sell off to correct some excess, that these people over 55, over 60, approaching 70 might hear, well, the market might churn sideways for a number of years and dollar cost averaging is a good place to go and a good strategy. And they go, wait a minute. I don't have like it was 2000, 2013. There was 13 years of sideways action. 1966 to 1982, there was 16 years of sideways action. If we're going to do something like that, I don't have 16 years or 13 years to wait for my net worth to get back to where it is today.
Right.
In 13 years. I'd like to live to 117, but I can't be promised that I'm going to live to 117. And then you've got the 35 and 40-year-olds and the under 30 crowd saying, no, 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 bring it on, sell it off 50% and have it down there. I'll dollar cost average all the way in and I'll be ready for the next up move. And they might not be wrong. The only problem is they don't have any money. It's all the old people that have money. So what you could see is a compounding effect. If the market was to start to struggle, and if the fear was, all right, we're going to go into a long sideways action period, it's not the end of the world. But for me, if I'm 64 years old, I don't want to wait around. Now you're saying to me, maybe the stock market is going to return 6% over the next decade. And then I gaze my eye over here and go, most bond funds are yielding 5 and they have less volatility. I could get most of the returns out of the stock market with a lot less volatility in the stock market. Let's all, exit stage right and all go rush into bond funds and start to sleep at night. So that could trigger a wholesale shift in the market that we haven't seen. Now, last thought for you. Oh, but we saw this in 2020, the market sold off and the Fed printed money like crazy and the market recovered. And then we saw this sell off in 2022 and then the market recovered basically on the AI story. So the sell-offs don't last years anymore. They last months.
Right.
Well, you had two unique situations, right? In 2020, we had no inflation. We were worried about recession. We were worried about deflation with the global shutdown of the economy. And the Fed could just print $100 billion a day, which is what they were doing at their peak, in order to try and turn markets around. Today, with a worry about inflation, if they print money, they're just going to produce 6 or 7% bond yields. That's all they're going to wind up doing. They're going to make it worse. So printing is out of the out of the story. Second of all, 2022, we had the AI story that really helped to propel the market right back to its old highs. Okay, fine. What's the next trick? You got to tell me about the next transformational culture-changing technology, and you can't use the words artificial intelligence to tell me what the next one is, because that one's already in the market. I don't think there is one after that. Maybe later on there will be, but there isn't one in addition to that on 2025. What are you going to say? Quantum computing or something like that? That's, I still think, would be all part of the AI revolution right now. So
short of aliens coming and sharing their, otherworld technology with us, it's hard to envision something amazing like that.
Right, exactly. So we're in a period of a long slog. And like I said, a long slog, I'm talking about, the stock market, if it was to return 5 or 6 or 7% versus a 5% bond market, that's still more than inflation. That is still more than, you will get real value out of being an investor during that period because you'll grow more than the inflation rate. But if you want to augment that on top of that mid-single digits return, that's where you come back to active management, thematic, stock picking, and that kind of thing to try and hopefully augment it from there. The augmentation no longer is, do I buy some other giant asset class like emerging markets? Or do I buy small cap stocks? Or do I buy European stocks? Or do I hold large cap US stocks? That used to be the way we augmented it. I think now it's going to be a little bit more thematic.
Okay. So another potential wrinkle here or concern, I'm curious if you share it, is so we've got an embedded investor base that just knows the passive playbook, right? And it's funny because you're talking about, we might have really disappointing returns of like 5 to 7%, right? And it's like 7% has
Yeah.
traditionally been kind of the normal average, right? We've just gotten spoiled these past couple of years. We've had, 220+% years in the markets. But let's assume for a second that scatter plot's right, and we're going to get sort of a sideways market for the next decade, right? Maybe a little bit positive in the long run, but still pretty sideways. It's highly likely not just going to go sideways in a straight horizontal line, right? It probably is going to be pretty volatile, right? So you have the compounding effect, or the additional concern that if there's some real volatility in there, your passive people who don't know how to kind of manage through volatility get shaken out, right? So it becomes the boomer not saying, oh, I don't have time to wait, 10 years just to get back to even. It could be, I got shaken out of this thing because my portfolio got cut in half and I sold it all, right? And then the market went back up and I'm still down here 50% less. And then it goes sideways for the next couple of years. So it takes me maybe 20 years to get back to average. So is there a concern there about how the volatility could actually make this worse for the average investor?
Yeah, for the average investor, unfortunately, I'm going to go a little bit boomer here on you. The average, the youngins, the people under the age of 40 aren't investors. They're gamblers.
They're
They're zero,
speculators. Yeah.
they're speculators, they're
But
gamblers, they're
but
zero
let me just
DTE.
mention the stats so you can include it in your answer. I mean, the
Yeah.
boomers are kind of getting that way too. It's 50, retirees have never had this much equity exposure in their portfolio for their age. I think it's something like 50% of boomers have like 70+% of their financial assets in stocks at this point in time. And a lot of those, whether they know it or not, are in these Mag 7 stocks, which are great, but if, trees don't grow to the moon, those may have a correction at some point. So they're even taking on a lot more risk than past generations of seniors did.
A third of the S, just to your last point, a third of the S&P 500 is seven stocks, the Mag 7. I can't tell you the number of people I said, well, I'm not investing in the Mag 7. I own like the S&P 500. No, a third of your money is in is in those seven stocks if you own the S&P 500. And I've even gone as far to say the single most important investment person in 2025 is not Jay Powell, it's not Warren Buffett, it's Jensen Huang, the CEO of NVIDIA.
Yep.
What NVIDIA does or doesn't do, performs or doesn't perform, is going to impact everybody. And so, that is the most important stock to watch right now. And so we're all kind of playing in that game. But you're right, in terms of the speculative categories. A quick word about speculation. I'm not against it. I think it's fine. But the problem with investing, the Warren Buffett type of investing, you only need to do one thing right? Buy something of value, hold on to it, let it realize that value. You only need to do one trade. In speculating, you need to do two trades. You need to get in at the right price and you need to get out at the right price.
Yep.
You've made it twice as hard as a speculator as you've done as an investor, because you've got to make twice as many good calls as a speculator. So a good speculator is twice as good as Warren Buffett, because he's only had to make half the number of calls that a speculator has had to make. And
And it's
some
hard to be
people,
Warren Buffett.
right. And now you have to be Warren Buffett squared in order
Yeah.
to be a successful speculator. That's why, the Forbes 400 list of billionaires is full of investors, but not very many traders. There are a couple on the list, but there's far, far more investors on the list than there is than traders.
Just to your point there too about how overexposed this market is to the Mag 7 and NVIDIA. I've mentioned all the stats in previous videos, so I won't mention them here, but I did create a little meme out of it. I'd love to get your general reaction to. So this meme, and again, I won't go through all the stats, but basically the global stock market, the US stock market is the highest percentage of the global market cap it's ever been. So the rest of the world is more into the US equities than it ever has been. As we talked about earlier, US equities have never been this concentrated in so few stocks. So it begs the question, what would happen if these Mag 7 stocks disappointed in some way? Would they take the whole system down with them? And I've heard people argue yes, some people no, but I think we can all say probably nothing good is going to happen if these stocks start to underperform.
Yeah, if they start to underperform, I mean, they're going to hurt everybody's performance because it's so concentrated. And the other thing too is they're so interlinked with each other too. You know, I mentioned earlier that NVIDIA is the probably the most important stock, and they make the chips that power the AI revolution in the data centers and everything else. Who are NVIDIA's customers? It's the other Mag 6 companies.
Right.
They're over, so NVIDIA sells its product to Google, and then Google creates, it's all ancestral between all of these companies, that they're one giant blob is what they are. So we have to realize the promise and the hope of artificial intelligence in the prescribed time period. That last part is the most important. Do I think that artificial intelligence is going to be as revolutionary as they say? Yes. And do I think we're going to have, fully automated self-driving cars and maybe do away with the driver? Yes. And create whole new industries and whole new business models? Yes, yes, and yes. It's going to be a big deal. Is it going to be a big deal by December of 26? Because it has to be, because that's what the market has pulled when you said pulled forward. It's got a timeline on it. It's going to be disappointing. Otherwise, it'll be like it was with the internet in, the early 2000s. Did we fulfill the promise of the internet by 2025? Absolutely. But we didn't do it by 2003, and that's why the Nasdaq fell 80%, because it had been priced it in that we were going to have everything we have today by 2003, and it took just a little bit longer than we thought. So two things can be true at once. All the hype and promise of what this technology is going to give us is going to become true, but also that these stocks have already reflected that reality. And if they have, the good news is it might be concentrated in 6 or 7 or 8 stocks that, could struggle. The bad news is they're a 30-year portfolio, whether you like it or not, and they could
Right.
wind up dragging down the performance of everything as we go forward.
All right, so I want to talk about the dangers of, if that happens, the bond market might not be the safe ballast that a lot of people are assuming it might be. Real quick, I just want to note, I don't know if you follow Fred Hickey's work much. He writes The High Tech Strategist. He's been writing it since the 80s, right? And you
Right.
would kind of think, hey, if somebody was going to be really bullish on, AI stocks, it would be a guy like Fred who's, spent his whole life in this industry. He's really bearish on them, largely for valuation reasons, but he also, has some concerns that a lot of, that maybe a lot of the current AI isn't as, it's more evolutionary than revolutionary. And again, I think like you, Dave, I think he thinks, yeah, eventually we're going to get to this Jetsons future that everybody's assuming, but it may take a lot longer currently than expected. And one of the last time I talked to him, which admittedly was probably like 3 or 4 months ago, he had a bunch of quotes from like, the CIO of Microsoft and other places that were saying like, a lot of our AI projects aren't making it out of the lab, or we're just not seeing the ROI to revenue or certainly to earnings on the timeline we thought we would. Now, this is a work in progress, and maybe the benefits start accelerating from here. But just a guy like I put some weight on that with a guy who's followed this industry forever, who I think should be really bullish on this, is that bearish. It does give me pause.
So one real quick thing about what's different about AI than the internet itself was the internet was more of a low cost decentralized technology, right? We created the internet. All of us could go on to GoDaddy, spend $10, build a website, get a domain name, and get some free tools and start building websites and doing kind of cool things with websites. Eventually, creating social media and stuff out of a dorm room at Harvard University. I'm talking about Mark Zuckerberg. So it was cheap and it was efficient and it was available to hundreds of millions of people to unleash this Cambrian explosion of ideas. AI is the opposite. It's 6 companies all being fed by one, supplier in NVIDIA, and these data centers are so expensive and such a big consumer of energy that Microsoft signed a deal to reopen 3 Mile Island nuclear plant to power this thing. So it's not like you and me in 2000 and 2001. Hey, I got a free Gmail account and then I, spend $10 getting a website and I'm going to kind of build out a business around this website. It's the opposite. I want to get in AI. Okay, do you have $100 billion? Otherwise, you aren't getting into AI. And so, like I said, that doesn't mean that there isn't a promise there. It's just a completely different setup than what we were used to. And what I'm afraid of is investors are saying, "Oh, I didn't believe the internet thing 20 years ago, and I'm not going to make that mistake again. I'm going to go all in on the technology now." Well, fine. You can go all in on the technology, but do you really understand what it is that makes this one different than the last cycle?
Right. Well, and as you said earlier, like there's a lot of people who are invested in these stocks that don't even realize they're invested in these stocks, right? Like, okay, I'm just
Right.
buying the S&P because I just want to be safe and play the index. Okay, to your point. All right, but you got over a 30-year market value in these stocks. And then there's just with the explosion of ETFs out there, these stocks are so, these 7 stocks or 10 stocks are so overowned that they're in all these other ETFs that you wouldn't even imagine were in big technology companies, but they have to be, right? So um, uh, point being is the exposure here is probably some multiple of what investors realize it is. So anyways, so in the tweets that you've been mentioning about high valuations, you said maybe this year, being 2025, is another good year, but you should expect the next decade to be a real struggle, right? And that's for the valuation scatter plots you had earlier.
Right.
Um, but you then came out with an article titled "What I Learned from My First Year Managing Fixed Income," and maybe you can just spend 30 seconds explaining to people why it's technically your first year, not that you haven't been invested in bonds before. Um, but you have said, hey, everybody, if we do get a stock market correction, a big correction, don't pin all your hopes on bonds being a protective shield for the rest of your portfolio. And I think it's because correlations have pretty much turned positive between the two asset classes, correct?
Yes, correct. So the first part, we started an ETF, or we started an index, a discretionally managed index called the Bianco Total Return Index. It's got a website called biancoadvisors.com. And our partner Wisdom Tree in December of 23 started tracking our index via an ETF under the ticker symbol WTBN, Wisdom Tree Bianco Nancy. The Wisdom Tree Bianco Fund is what its official name is. So 2024 was kind of my first year managing real live money via this index and this ETF that tracks it. So think of it as like, the Bloomberg U.S. Aggregate Bond Index, and then WBND or AGG track that index. So we were set up the same way. And the good news is we actually had a very good year from a relative perspective. We were in the top quartile of all total return bond funds. We did much better than the average fund. We did much better than the index, even on an after fees basis.
Congrats. You were like the
So
top 19%, something like that?
yeah, something like that. We were in the top 20% of about 470 funds. And so, it was so it's not my first rodeo in the bond market, but it was my first rodeo under this discipline doing this in the bond market. So we started off with a good year, yay for us. Now, to the point that I was bringing up in that letter is that most people buy into this idea that there's a 60-40 portfolio where you want to own 60% in stocks, broad-based stocks, and 40% in bonds. Why do you own the bonds in 40%? And I've referred to them as crash insurance. You want to own bonds because if the stock market goes down, you expect a massive rally in bonds to kind of cushion the blow on the way down. We invented a term for it called the risk-off rally. When stocks rally, we call it a risk-on rally. I think that era ended in 2020 when the cycle changed in 2020 because of the higher inflation. We could talk about that in a second, why
We will.
I think we have higher inflation. That means that the correlation with stocks and bonds has been rising. In other words, their prices go up and down together. And if their prices go up and down together, that is reminiscent of what we saw in the 70s, 80s, and 90s. That's exactly the way stocks and bonds used to trade. What that means is bonds are no longer crash insurance. They won't save you if the market goes down, other than to the extent that they're lower volatility. They've got bigger coupons, 5% coupons. They've got lower price volatility than the stock market. So they'll perform better than the stock market, but they're not going to rally huge like you were expecting in 2018 or 2019 or 2008 in order to basically cushion any kind of a blow. That's why I've said that the new 60-40 portfolio might still have the same weightings, But you might want to be looking at this idea that more of your money is in this lower cushioned bond fund because you say, look, this thing's going to churn out 5% coupon plus or minus whatever the price moves, and the price doesn't move that much. So it gives me kind of this backbone of a portfolio that it churns out a lot of returns for me. Now I'll add a little bit of like S&P 500, maybe 20-ish%. And then the rest of it, you might want to start thinking about that thematic ideas, buying stocks or growth stocks or thematic ideas, or investing in an active manager to try and get some higher returns with higher risk and spread it around, diversify it. Some of them might win, others might lose, but hopefully you have more winners than losers. What I'm trying to describe here is a rethinking of the way that you structure a portfolio. And what I'm really describing is the way you used to do it 20 years ago, not the way we used to do it now. Just buy the S&P 500 and own some bond funds. S&P 500 always goes up, and when it goes down, the bonds rally and make everything better. That's not the way I think it's been working for the last couple of years, nor is it the way it's going to continue to work like it has been. Think about it like how you invested in the 80s or 90s, and that was 40% in bonds, 20% in broad indexes, and then the other 40% or so kind of mixed out, in thematic and stock picking ideas.
Yeah, little bit of hot sauce in there, as I think
Yeah,
you.
the hot sauce, there's nothing wrong with the hot sauce idea. I mean, even if you want to throw some crypto in there by a couple of percent or something like that, sure. Some of them will win, some of them will lose. And, you want to bet on that you'll have more win, or the winners will go up more than the collective of the losers and make you, something like a 9 or 10% all in type of return. And a quick word, you mentioned this earlier about the 220% gains. I could see or envision some people going, 7%, 9%. Come on. The stock market went up 20% last year, 25% the year before. Even gold was up 20%. Bitcoin was up 120%. That's what it does. Yeah, I want you to give me a 50% idea for 2025 or a 30% idea for 2025. Those were the last couple of years. And the problem is so many people are momentum investors, right?
Mhm.
What's your opinion of the market? Well, tell me what it recently did. It was up 20%, so I think it's going to continue to go up 20%. It was down a lot, so therefore I think it's going to be down a lot. So the problem with momentum investing is I've always used that meme from the original Top Gun movie, right? Maverick, that is some of the best flying or investing I've ever seen, right up until the moment you were killed. And that's
Yeah.
that's the thing about momentum investing. You are a genius to the moment that your plane hits the canyon wall, and then you're done. And that's what you have to be careful of with momentum investing.
Yeah, and I think that's a valid concern here. We were talking earlier about how so many investors today, percentage-wise, really are more speculators than
Mhm.
true investors. And the analogy I've used, which you'll appreciate because you live in the Chicago area, um, I talk about, like, when your team wins the Super Bowl or an NBA championship, right?
I wouldn't know anything about that, a team
Yeah.
winning a Super Bowl.
Well, your city, think back a couple of decades. Um,
Yeah.
but when your team wins the Super Bowl the first time, you're thrilled, right? When they win it a second time in a row, you're ecstatic again, but now you're thinking dynasty, right? So you go into the third year already expecting you're going to get the championship ring. So, even if your team makes the playoffs but doesn't get the Super Bowl, you're still really disappointed, right? So we kind of have everybody sitting here expecting yet another Super Bowl victory year, and they might just be sleepwalking into this buzzsaw of what you're saying, which is like, hey, the octane that drove this thing, may very well be over. So you have people that are very momentum addicted right when the momentum, ends. And to your point, this is right where your phenomenal flying record hits the canyon wall.
Right, right, right. So I talked to somebody in Kansas City, and they actually have canceled all of their plans the week after the Super Bowl because they want to attend the parade. It's like, oh, okay. So this is
See, exactly. That's
this.
exactly, yeah.
Yeah. Who else thinks of that? Do you think people in Detroit are saying, well, the week of the February 10th, I better cancel all my plans because I want to go to the parade when the Lions win their first Super Bowl in history. No, you just want them to win. You're not
Right, right.
thinking that far ahead and stuff. So yeah, you're exactly right. And I would actually, I've used the signal in the marketplace is we are a DraftKings FanDuel world right now because
Hmm.
gambling is such an important part of what we do. We saw it with the meme stocks in 2021. We're seeing it now with the way that if you're a sports fan, and we are sports fans, and if you're listening to us and you're not a sports fan, I'll just say to you, gambling is consuming professional and now the college sports. Everything is about gambling. Everything is about your proposition bets and your parlays, and everything is being driven by that. And it's become almost to the point where it's taking away from the purity of the athleticism of sports.
Right.
And there's another boomer comment for you as well, that I'm not just, waiting for my 6-way parlay to hit, if this guy can throw a touchdown in the next quarter or something like that. So that is being permeated in the financial markets as well, too, that kind of gambling culture that we have right now. And that's why we have so many speculators and so few investors.
Right. And I hate to use this analogy, but we'll hopefully have a little bit of time to talk about this near the end. To a certain extent, my concern is that, I'm not necessarily it's going to be this year, but the risk we're talking about is the potential sort of investment equivalent of what just happened in Los Angeles, where people had owned their homes there forever, to the point where their homes were fully owned, and the insurance had gotten expensive enough that they're like, well, I own the home now, I'm not going to pay for insurance on it, right? And then the LA basin burns, right? And you've just lost not just the roof over your head, but a huge part of what you thought your wealth was, right? It could be something that could catch people by surprise at that level of magnitude. But let me say this, Jim. So your point there about, okay, bonds may not actually be the buffer, against a market.
Before you go on the bonds, let me just throw out
Yeah.
something real quick on that last comment you
Yeah.
made. Everybody wants to get 1,000x return in something. And there is a tried and true way to get 1,000x return in something. I've done it. You've done it. Start your own business from scratch,
Right,
and become successful. And that was the way it is. You want to know who's made 1,000x return? The successful restaurant in the corner, or the business down the street, or the guy that's a founder of something. They started it with nothing, and it's now worth something substantial. And that's your 1,000x return. What's different now is everybody wants somebody else to make me 1,000x. I want to invest in something, kind of ignore it for a little while, and then wake up one day and go, oh, wow, it went up 1,000x.
yeah.
And I didn't have to put my effort, my blood, and my sweat, and my risk, and my thought, and my intellect into it to make it do that. So there is a way to do it. We used to do it from the time immemorial, and millions of people have done it that have started small businesses, and they've been very successful and supported them their whole lives. It's just that what's changed now is, no, I want a ticker symbol that's going to do it for me. And that's very difficult to find. And yet, but a lot of people think it isn't.
A great point. It goes back to your earlier point about if you look at the Forbes, 500 or whatever, Fortune 50 or whatever, it's not really, not many people got there through investing. It's people who got there entrepreneurially, right? They
Right.
created value, right? And we're seeing kind of the downside of what you're talking about in many different areas, not just the financial markets, but like a great example is the short-term rental market, right? Everybody piled into that thing because, oh, I can just put some money into this house and it's going to just mint cash flow for me, right? And all of a sudden they're realizing, oh my God, these things are actually cash losers, right? I'm hemorrhaging through these things. So yeah.
Right. And just to finish off of my thought, and who are the people that really made a lot of money in real estate? Real estate people that spent their lives just doing that, developing real estate and, being, successful real estate investors. They weren't just people that threw some money at some limited partnership and hoped that somebody else would do the work for them.
All right. That might actually be a topic for us to maybe drill into a little bit more in a future conversation here, Jim.
Mm-hmm.
So I'm going to earmark that here. But back to your main point about bonds, potentially not being the shield, the crash shield that they once were. I mean, we only need to go back 2 years to see, yeah, that's right. That's what the theme of 2022 was. Right? It's like one of the worst years combined for bonds and stocks in like the past 200 years or something like that, right? I mean, bonds just, they didn't go down as much as stocks, but they went down a lot more than I think people were expecting they would, given what happened in stocks that year.
Yeah, but bonds also had a property in 2022 that's not existent right now. That was they started the year with the funds rate at effectively zero and with interest rates starting at 1%. So if you owned a bond fund, you were getting very little coupon income from a bond fund. If you owned a money market fund, you were getting anything. And by the properties of the bond market, it's called convexity and duration, that when
Hmm.
you have very small coupons, you have very, bond prices are very, very sensitive to movements in interest rates. So when interest rates moved up and prices fell huge and you didn't have much of a coupon cushion. Okay, that's why you had that rout in 22 and into 23. Fast forward to 24. Well, you had a rise in interest rates in 24. I would actually term that 2024, and I'm talking about like the broad aggregate indexes,
Yep.
was not a good year, but it returned you positive 2%,
Right.
positive 2%, because you had a big coupon to start the year. As the coupon goes up, bond prices become, their duration shortens is the technical term. They become less sensitive to the movement of interest rates. So when interest rates rise, the prices don't sell off as much. You get a bigger coupon to throw off income, and you wind up actually with a positive return. So the bond market needed to get from zero interest rates to five, and that was awful for investors to sit through that. The good news is that's over. We're already at 5%. Actually, I did some back of the envelope math and I was like, okay, what would it take over the next 2 years for the bond market to lose you as much money as it did in 22 and 23? And the answer is you'd have to go to about a 17 or 18% interest rate. Now,
Wow. Really?
we're not going to do that. We're not going to do that. The point is that's what happened in reorienting the bond market at a 5% coupon now and a much shorter duration. That those kind of 15, 20% losses that we saw all in on the indexes, they won't happen again unless, we have some kind of a apocalyptic scenario in the financial markets. So the bond market is a much safer vehicle right now. Safer in that it will churn you out a coupon and those price movements won't be as big. A bad year might be plus 2%. A good year might be 8 to 10%. All in averaging over the next several years, 5 or 6%, maybe closer to 5 as a return out of the bond market. Like I said, the problem with that was you tell people that and they like their forehead crinkles and go, what do you mean? I'm making 20% a year in everything I'm investing in. I don't want to look at something that's going to return me, 5 or 6%. So it's all about
Right.
expectations and trying to get everybody to think about these things the right way.
But those are the same people who in 2022 were coming to me and saying, can you please just help guide me to something that can give me a safe 4% return? That's all I care about, right? Because they were bleeding
Right.
from the eyes on their equity holdings. Yeah,
Right.
exactly.
And keep in mind too, what the bond market's also doing for a lot of people is, and these yields are doing for a lot of people, is it's reorienting, some of the investments. We used to joke about from 2010 to 2020 when money market funds were zero, that was probably killing more people in Boca Raton than their old age was at that point
Hmm.
because they weren't making any money. Well, fast forward to today, a money market fund is still yielding in the low fours. The inflation rate is, if you go with CPI, 2.7% right now. A money market fund has a $1 NAV every single day. Put your money in a money market fund, you're going to beat inflation. It's not hard now to beat inflation because of these higher yields. And if we start thinking in those terms, then all of a sudden the investment landscape isn't as daunting as we thought. But too many people aren't thinking that way. They're asking me, is Bitcoin going to go to 250,000 this year?
Right.
Can we get another 50% out of the Mag 7 stocks? What's the next super micro that's going to go up 1,000% in a week? That's what people are trying to orient themselves towards, as opposed to, hey, look, there's some very low risk options out there that I could structure a very sane conservative portfolio that could churn me out 2, 3, maybe 4% more than the inflation rate. And I should start thinking that way instead of this gambling mentality of what's the next super micro.
All right. And I mean, the good news is a lot of the people who watch this channel, I think, are their natural proclivity is to look for the best risk return offering rather than just the best risk offering. At
The
least
speculators
I
would
hope that's
refer
the
to
case.
that as being bearish.
They would. Exactly. For
Yeah.
some reason, prudence is now extreme
Right,
bearish.
right, right. Because unless you tell them to buy this because it's going to be a 10 bagger, you're bearish, according to too many of them.
All right. So uh, we're getting close to the hour. If you don't mind, Dave, Jim, we may run over the hour a little bit. I'll get to kind of the lightning round in a moment.
Yeah,
But
sure. Go right ahead.
I very much appreciate that point about for bonds to lose as much going forward as they have in the past 2 years, we'd have to have yields up in the high teens. Uh, that does sound like that makes bonds a much safer trade than maybe many are expecting right now. Because I think folks are afraid that yields could still go higher from here, and they don't
Well,
want to.
they could, but like just to remind everybody, the beginning of 2024, the 10-year yield was at 388. It closed at 460. That is an 80 basis point rise or 0.8% rise in the yield in bonds. It returned 2% because the coupon was bigger than the price loss that you
Right.
took from going from 388 to 460. And at 460 or 470, where we're, nearly 480 right now on the 10-year yield, that price movement with higher yields continues to dwindle. So it gets less sensitive. It moves less and less as interest rates go up, even though the coupons get higher. So that's the benefit. That's the property of bond math. Like I said, I can't emphasize enough that bonds were nothing but pure risk when you were sitting at a 1% coupon and zero on the funds rate
Right.
with very long durations. That was when they were pure risk. But that, like I said, getting off of that to where we are today was 22 and 23 in the horror show that was the bond market. Well, that's behind us right now.
Okay. So very important point for folks to digest on that. All right. But when we look to the future of bond yields, interest rates in general, you have to kind of start with a question, but where do we think inflation is going to go from here? From having read your recent work, it seems that you do think that inflation is going to continue to be an issue. I don't think you think that, don't let me put words in your mouth, but I don't think you think the Fed, you're taking Jerome Powell at his work, at the surface of his words that, hey, it's a little sticky, but we feel like, pretty soon we're going to get it down to where we need it to be. Where do you think inflation's going to go? Because, and let me just read this one quote of yours. Fed cuts were unnecessary and are raising inflation expectations. The Fed has the wrong policy. So explain why, and I wish we were having this conversation tomorrow because we'd have the new CPI and PPI numbers, but we don't. But anyways, go ahead.
It's okay. It shouldn't matter. This comments will survive those numbers regardless of what they are. I've been arguing that, just bigger picture, that every time you have a recession or a financial crisis in an economy, and we had both in 2020, you change it. And we changed it. We had a shutdown of the global economy and a restart. And it's changed. And as I've said this with you, change is not dystopian. It's not worse. It's different. If you want an example of the change, remote work is the the enduringness of remote work. Now, without getting into the remote work thing, it's changed the labor market. That episode changed the labor market. So what I've argued is that coming out of that secular move, we are now in a higher inflation world. As I mentioned earlier, think it's 3-ish% inflation, not sub 2% inflation, not 8, 10, or Zimbabwe inflation. So when I say inflation, let's talk about 3. So where does that 3 and this whole idea that the markets are going to look more like the 80s and the 90s and stuff? Well, 3% inflation, 5% yields means the 2% real rate, meaning the interest rate above the inflation rate is 5 minus 3 is 2. The real rate is 2. That is kind of standard fare for where we are in the world. And that's why I'm not concerned about the idea that the 10-year yield might go to 5 or might go beyond 5, although everybody else is working themselves into fits because they still remember the zero interest rates of 2010 to 2020 and somehow think that that was normal, where I've argued that was abnormal, and we're not going to go back to that abnormal period. This is closer to normal. So the inflation world that I think we're in is in that 3% range. Now, to the quote you asked me about, what I've argued, I've mentioned this earlier, at the beginning, the US economy is doing okay at the top line. I understand it's a K-shaped economy. The top half is doing better than the bottom half, and there's some real issues with the cumulative increase of prices for people on fixed incomes that don't own assets, that are renters, and take public transportation, to give you one example. The cumulative increase in prices has really hurt them. I understand that, but monetary policy can't fix the K-shaped economy. It can only respond to the top line, and the top line, the economy's been growing okay. And on top of that, we've got Trump coming, and that's very stimulative. Deregulation, extension of tax cuts, maybe new tax cuts, possibly some levels of tariffs as well. That should boost the economy even more. So what I've argued is the economy is growing at its potential. Trump's going to push it even further. Thank you very much. That's all we need. Now comes Jerome Powell cutting interest rates, giving us more monetary stimulus. And I think that the bond market is saying, no, we don't need that. It's not necessary. All you're doing with your monetary stimulus is raising the specter of higher inflation, which is why what you've seen unusually is, as the Fed has been cutting their funds rate, long-term yields have been rising. That is unusual. In fact, I've published a chart on social media, and in the last 60 plus years, there's only been one other time in 60 years that we've seen interest rates go up this much as the Fed, or long-term yields, I should say, as the Fed has been cutting its funds rate. That was 1981.
Yeah.
That was the period when the funds rate was 20%. Yeah, it was 20%. And the Fed in May of 81 started to cut that rate. And the bond market didn't like it. And it took 10-year yields to 16%. Yes, they went to 16%. And Ed Yardeni coined the term bond market vigilantes. Why did he coin that term? Because what he was saying was the bond market was saying to the Fed, we want you to be worried about inflation. And if you're going to cut interest rates, it says you're not serious about inflation. I don't want anything to do with your bonds. I sell bonds, the price goes down, yields go up. That is the bond market vigilante walking away from the bond market. I think there's a version of that going on right now. Jay Powell, you're not serious about this inflation thing. You keep telling me it's fixed. Doesn't look fixed. The market thinks that we might be in an elevated inflation world. Again, 3, not 8. And 5 on yields with 2 real. And if you're not going to if you're not going to accept that reality, that that's the world we live in, and you're going to give me too much monetary stimulus, maybe I should start thinking about 4 and 6 instead of 3 and 5. And that's why you've been seeing this rejection of this policy through rising yields. Now, a lot of economists have pushed back on this idea and said that, no, it's not about real, it's not about inflation or anything else. And this is a debate. But I think that, the data does support that the inflation rate is not coming down anymore. I'll give you one number, core PCE, and it should survive the December number, the statement that's coming out tomorrow, unless something extraordinary comes out of that data. We have had 44 months in a row where it has been above 3%. It bottomed in May, and for the next 6 months, it hasn't made a lower low. That's the first time since it was at its peak in 22 that it's gone 6 months without making a lower low. It can't get below 3%. And the Fed keeps telling me, no, mission accomplished. We're on our way to 2, and we could start cutting rates. Wait a minute, you can't get under 3 on the core CPI rate right now. And it's been above that number for 4 years. And it looks like it's going to stay above that number in December and in January by all of the estimates of where inflation is going to go. And this is what's bothering, I think, the marketplace, why you're seeing interest rates creeping up. And the last word about that, creeping up interest rates seem to be giving the stock market indigestion. I don't think it's because the stock market's saying these are punishingly high borrowing rates, and this is going to materially slow the economy. I don't think that's what's worried about. It's saying people are going to start thinking that 5% bond funds are a better option than stocks. And maybe we're going to see this is competition for us. And we're going to have to compete with this. And people are going to start taking a right turn and saying, yeah, thank you. Give me that 5% with the lower risk than trying to get 6% with much higher risk in the stock market.
I think we also, I saw that used the stock the other day, but it's showing that the average earnings yield in stocks is now, I think, a less than the 10-year rate, which doesn't
Right.
happen all that often, right? But to your point, I mean, bonds are starting to look a lot more competitive to the average stock out there.
Right. And when the average earnings yield gets below bond yields, why would you buy stocks under that scenario? Why wouldn't you just transfer in the bonds, get out of stocks
Exactly.
and get in the
Yeah.
bonds? Because you think that there's going to be heady growth to explain or to, justify paying up those valuations. Okay, there very well might be, but the problem comes in, everybody expects it. Everybody wants it. Everybody's pricing it in. And that gets back to the whole, kind of AI argument as well, too, is that that growth has to come now. It can't come in 5 years. So, that is really where the rub comes in, is that will we get growth beyond what is expected? And we've already got pretty bullish arguments about what kind of growth we expect to see driven by new technological advances.
Okay. So Jim, I interviewed Bill Fleckenstein last week, and it seems like you guys are pretty simpatico in how you're looking at the dynamics of the bond market right now. Bill's general prediction going forward for the year is bonds leak until stocks tank. So he sees that yields will probably keep creeping up, up until some point that the market says cries uncle, right? And there's some corrective event there, and maybe there's a safety trade back into bonds that gets prices back up or whatever. Who knows? But that's kind of his general outlook. Do you see somewhat similarly as he?
Yes, I do. And when, I'll buy into that argument that bonds continue to leak yields higher until stocks, you have a problem with it. What I'm afraid of is, why are bonds leaking higher? I think it's because of inflation. I think it's because of strong growth. If the answer is that bonds are leaking higher and stocks suffer more and more and more, and then people say, oh, I know, dust off the 2020 playbook or the 2008 playbook. Let's start cutting rates massively and consider the idea of quantitative easing.
Mhm.
I think that would be disastrous if that scenario is correct. Because if the market is leaking yields higher and the stock market is struggling over the concept that yields are competition, and you throw all that out in the window and say, let's just feed more stimulus into this, the bond market's going to go crazy thinking all you're doing is just creating even more inflation. We got to
Yeah,
sell off bonds even harder.
you're putting gas on the fire. Exactly.
Right, exactly, exactly. See, that's the real question that people have to ask. You said prior to 2020, you could pour gasoline on it because there was no fire. We were worried about deflation. Now, deflation is often referred to as ice. Now we're worried about inflation, and it's often referred to as fire. And if we are having fire and you pour that same gasoline on it, it just makes it worse. So that's really the question. And I hear way too many economists saying, no, the Fed needs to be more aggressive in its easing. That will bring down bond yields. That will calm down the stock market if it would talk about more rate cuts, not less rate cuts. And so, really, are we in an ice world or are we in a fire world? I think we're in a fire world right now with inflation. Three, not big, but enough that if you don't respect three, you can wind up making it a lot higher with bad policy.
All right, two questions. One, I'm just gonna ask the same question I asked Bill, which is, so you're taking your best estimation of what you think is driving bond investors here. You
Mm-hmm.
know, I mean, you live, you swim in the sea of active invest. I mean, do you actually talk to real bond investors and just say, hey, what's in your head? Are yields going up because you're concerned about inflation, or is it for a different reason? Like, are you getting any primary feedback from bond investors themselves?
I spent all day talking about investors. That's part of my research business is professional investors. Yeah, I mean they're asking the question, why are yields going up? And they are coming to the conclusion that we have a sticky inflationary world, we have a strong growth world, and we've got a president coming that's going to feed that. Like I said, there's nothing wrong with that. And I would even go you one step further. That actually might help the K-shape, right? If you get very strong growth and you get, things moving along, that maybe people at the bottom end will see more opportunity for higher wages, better
Right.
job opportunities, and the like. And people at the top end will be just whining and moaning that their portfolios are not returning them 20% like they did every other
Bitching
year.
about a 6% annual return. Yeah.
Right, exactly. And that, that might actually help the bottom end a little bit more. Jay Powell used to talk about this in 2019, that the Fed needed to think about running a high pressure economy. That was the term that they used. Let's run the economy really hot. Why? Because it will help people at the bottom end. Because if you create so much demand, there are people that are, struggling to find jobs, struggling to find opportunities. But if you create so much demand, some employers will take them because that's all they've got to offer. So
Right.
let's run a high pressure economy. Well, what about the top end that wants all of their big fat returns? They might not get those. So that might not be a bad thing to do in that respect, but we're here talking about what it means from an investment standpoint. And that might mean that, you might have to augment or temper your thought process about where you think your investments are going to go.
Got it. Okay. But to my question, your rationale for why the bond market, the bond vigilantes are stepping up, it's not just a Jim Bianco opinion. It's you're talking to bond investors all day long, and
It's
that's
both.
yeah.
It's my opinion, and I'm hearing enough people say that as well too all day long, that believe that. There are others that don't. Markets are dynamic things, and there's lots of opinions in there. But there's a fair amount of people that are worried that no, the era of sub 2% inflation is behind us. That we're talking 5 on yields, 3 on inflation. That's got a receptive audience in the fixed income space, I think.
Okay. So now, yeah, enough folks in the fixed income space that has convinced you and through your other research that we're in a fire world, not a nice world. What's your response to guys like your friend David Rosenberg, who you were just in the double line conference with him
Yes.
and Jeff Gunlock and Charles Payne and Danielle DiMartino Booth? So unless he's totally pivoted from the last time I talked to him, I think he would say we're in a nice future, right? A nice world. So what would you say to him?
Oh, he's definitely still in the ice world, in that he's definitely still thinking that we're going to see a dramatic slowing in the economy and dramatic slowing in the labor market. Um, and truth be told, since you brought up Rosie, I was in Los Angeles with him 5 days ago, and I also had to go to Toronto on a business trip. So I sat next to him for 5 hours on a flight,
Oh, cool.
going from LA. So I got raw, undiluted Rosie for 5 hours. And I'm still kind of detoxing from it. I love Rosie. He's one of my favorites of all time. I
Yeah.
say that just in a loving way. But
I guess if you could put your finger, like where is the biggest point where your view and his diverge?
what did 2020 mean for the economy? Was
Yeah.
it a secular change in the economy? He actually said to me, not inflation, but a lot of other things, yes. I think a lot of other things, yes. And it was in inflation. That dramatic effect of 2020. And like I said, the financial crisis was a traumatic effect, and things changed coming out of that. 9/11 and the recession around that was a traumatic effect, and things changed coming out of that. The 1990 recession, when Saddam invaded Kuwait and 400% price in crude oil, that was a traumatic effect, and things changed coming out of that one as well too. So things change when you have traumatic effects. He didn't disagree with it. I think it also changed the inflation outlook. He doesn't, and that's really the I think the rub between the two. And he made some very good arguments about why it wasn't. And that's the thing about investing, is there's no such thing as an ironclad argument that this is just the only way it can be. It's all probabilities and inferences and our best guesses, and that's what mine are. And he's got some very good ones on the other side.
So at my last conference, the theme was if you're not confused, you're not paying attention. And the reason why is because I think more often than I've seen it in my career, we're at a moment where really smart people can look at the same data and come to different conclusions, right? So it'll be
I would argue that that's exactly why that's that whole 2020 thing, is that did things change? And the guy that I've really been really critical of is Jay Powell, because he has many times in his press conference saying, we're seeing broad normalization of the economy. We're
right.
seeing it return to a pre-pandemic level. And I've Jay, what's abnormal about this? What are we normalizing from? What are we normalizing to? Maybe what this is normal.
No more, right.
Yeah, and that
The,
you're
the
in
ZERP
that
era was the aberration. Yeah, exactly.
right. And as I like to shorthand it, stop waiting for 2019 to return again. That era is behind us.
Yeah. Okay. Gosh, I could go on forever. I've got to be respectful of your time. If we can, let me just ask a couple of quick, rapid fire questions. This lightning round. You can just give short little bites and then we'll wrap it up.
Okay.
Um, so one of the things that I think is reasons why you think 2020 was so transformative here is the work from home movement. And you've even mentioned that, refer to that once or twice in this discussion. Um, do you still believe it's the game changer you initially thought it was, especially with the pendulum, kind of starting to swing back to office, at least for a lot of big corporate America?
You're getting a lot of announcements that it's swinging back to office, big corporate America. The day we're recording, there's a story on Bloomberg out that JP Morgan, Jamie Dimon wants everybody back in the office 5 days a week. They're getting big pushback, and some of the employees are talking about unionizing so that they can push back against it. I think the biggest mistake that employers make, just real quick, is what problem are you trying to solve? What problem are you trying to solve by treating your workforce like a bunch of fifth graders that you want to back in the office and you're going to take attendance? Most of the time, they're not consulted. They're just summarily told to come back into the office. Um, um, uh, MIT professor Brian Elliott, who's done a lot of work on return to office, has pointed out that almost every one of these companies, whether it's Amazon or JP Morgan or whoever makes these grandiose return to office announcements, gets no movement out of their stock price on it. Well, the owners of the company, the stockholders, aren't impressed that you're going to force everybody back in the office. They didn't think it was a problem, and they continue to not think it was a problem. I think what it is that it's sedentary management. You've got to think about how to manage a decentralized workforce. And instead of thinking that way, you're just saying, screw it, everybody get back here, I'm taking attendance. And I don't know how that makes anything better. So my point is, for all these pronouncements that everybody's going to go back to the office, they never really do. We're already past January 1st, and Amazon is not seeing nearly the number of people going back to the office that they thought they were going to see. They're getting tremendous pushback from it as well. It's the new way we do things.
Okay.
Learn how
See,
to manage
the
for
genie is
outcomes.
out of the bottle here. It's not going
Yes,
back in. Okay.
right. And
And, and
by the
yeah,
way, remote work, if somebody's listening to me, I want to make sure we understand, is not 5 days out of the office. It's 3 in the office, 2 not in the office, or 3 versus 2, or 2 versus 3, or 1 and 4, maybe in some instances, but it's not never go back to the office. And so that's really what we're talking about in trying to get everybody to understand that
okay.
the
So it's
genie is
moving
out
to
of the
this sort of
bottle.
hybrid world. Yeah.
Right, right, right.
Okay. And
So just from a quick wording standpoint,
sure.
remote work means hybrid, which you would refer to. Work from home means 5 days 5 days at home.
Right, right. Okay, so you're much more of a hybrid future,
Yeah,
maybe work
I
from
think
home.
it's here and it's going to
Yeah.
stay.
Okay. And just what would you say to the people who say this is maybe a way to conduct self layoffs where you don't have to pay severance and stuff like that by, passing these edicts, losing some percentage of your workforce and just figuring out how to move on from there?
It's the worst way to do it because the people you're going to lose are your best workers.
Okay.
The person that will leave first is the person that can leave
It has
first.
the
And
most
who's the,
options. Yeah.
right. And they have the most options because they're recognized in their industry as a high performer, and other companies are willing to grab them first. What you'll be left with is the people you really want to get rid of. And the people you don't want to get rid of are the ones that are going to go.
Okay. Um, I told you before we turned the camera on here, I made probably the mistake of asking my audience on Twitter or X what questions they wanted me to ask you. So there's a whole bunch I'm not going to get a chance to ask, but there are one or two
Ask
that,
some of them. We could do a rapid fire if you
yeah.
want.
So your thoughts on the new Treasury Secretary candidate, Besant. Um, how you expect his approach to differ versus Yellen in running the Treasury, and a lot of specific questions around what do you think his role is going to be in terming out the debt? Do you think he's going to have a very different approach to Yellen, who obviously has bought a lot of short-term debt,
Big fan of Scott's. I think
issued a
he's a
lot of
great,
short-term debt?
right. A big fan of Scott's. I think he's a great choice, and he'll be a very good Treasury Secretary as we move forward. He's been pushing back a lot on a lot of Yellen's policies. I think he's going to probably see us move forward with increasing the amount of coupons that we issue to 5, 7, 10s, less amount of bills. That has not been a good policy the last couple of years. As interest rates go up, you as a bond investor always face a reinvestment risk, right? If I buy a 2-year note, my risk is where are interest rates in 2 years? If they're higher, that's fine if I'm the buyer of the notes, but if I'm the borrower, if I'm the seller, if I'm the treasury, and interest rates are going to keep creeping higher. I want to issue 10-year and 30-year bonds and not have to worry about interest rates going up. If I issue 3-month bills and they keep maturing and I keep having to, reissue them at ever higher interest rates, it just makes it worse in the long run. So I think Scott is going to definitely, look to kind of push us to term out the debt. I like his policy ideas of 333, which is 3% GDP. We're already there right now, I think. So that one's pretty much been accomplished before he took over. He wants to get the deficit to 3% of GDP. Growth at 3% of GDP. We're already there. He wants the deficit to go from 6% where it is now to
Right.
3%. I would love to see that happen. That would happen with Doge trying to, streamline the economy, and offering cost savings that could help us bring the deficit down in half. Because for those that worry about, well, if we're going to term out the debt and issue more 10 years, then interest rates are going to go up. Not unless we cut the deficit. And Doge is the program to cut the deficit. Well, how's all that going to turn out together with each other? Is it's going to be whether or not President Trump has the political capital to force these things along. Adam, you may remember when the peace dividend came and it came time to have all the base closures and stuff, and we couldn't get it done because congressmen didn't want a base to be closed in their district. I'm talking about military bases
Yeah.
because it was such a big boondoggle for jobs and for patronage and everything else that we had to finally have a blue ribbon commission basically take it out of Congress's hands and just say that base is going to close, that base won't close.
Yeah.
That's what Doge is supposed to do, is say, cut here, cut here, cut here, we'll get to 3% of GDP. And hopefully Trump has the political will to keep everybody on track with that they'll agree with it. So I'm a big fan of Bissett.
All right, that's going to be fascinating to watch. I wish them all the best. I've got to admit to some skepticism, but I'd love for them to succeed. Sorry, you said 3%, 3%, 3%. I got 3% GDP growth, reduce the deficit from 6% to 3%. What was the other 3%?
Increase crude oil production by 3 million barrels. And the only pushback I give on that is that he's not the energy secretary. He's the treasury secretary. So I like that, the idea of increasing production. Whether or not it is possible is another question altogether. What I mean by whether or not it's possible is, do we have the engineering ability to increase 3 million barrels a day in the United States? Yes. Even if you accept that environmental rules would allow it. The other problem is, if you did it, does that push oil prices down to $40? And then the oil companies say, but I don't want to do it because it's not economic
Right.
to be, at that point. You need to kind of do it and keep prices at least $60, if not higher. And that is going to be a real challenge.
Okay. I'm going to jettison almost every other question here just out of time. But you'll just have to have you back on, Jim. But let me ask you this. So I always like to conclude these conversations on the so what. All right, it's regular investor. We do have some professional investors who watch this, but it's a lot of regular investors. So given your market outlook, what strategies or asset classes do you think are worthy of consideration for the road ahead? you've already largely answered that in your
Yeah,
new portfolio construction model. And I put it up on the screen while you were talking about it. I pulled it from your piece there about what you learned during managing your first year managing fixed income, so folks can go back and relook at that if they don't remember it. It does seem like you think that this is a year where risks of disappointment are a lot higher than they've been in recent years. Doesn't sound like you're chest beating on stocks. Doesn't sound like you're chest beating on bonds necessarily, meaning you think they could continue leaking, right? Like Bill does.
right, right.
Um, but obviously, hold a healthy amount of them in your opinion. Are there any other strategies or assets that you think, given the idiosyncrasies of 2025, are important to look at one way or the other? And I know folks are going to ask me about Bitcoin, so if you have anything to say about that, feel free to say it. But gold, commodities, any other asset we haven't talked about yet?
Yeah. So, I mean, the thing about stocks and bonds is that I'm trying to think about them more than just 2025 over the next
Right.
couple of years and kind of positioning for that. And then, so really it gets into what are some of the ideas for that 30% or 40% hot sauce category
Yep.
that I could wind up doing. Bitcoin is definitely one that you can be looking at. The problem I have with Bitcoin is a very simple one. It's more of a speculative, it moves up and down more like a speculative tool than
Mhm.
it does, creating an alternative financial asset. If it was creating an alternative financial asset, it'd have a zero correlation to the stock market, but it has some correlation to the stock market. So if stocks are going to be kind of so-so, I think it's going to be kind of the same thing. And so far, it largely has been the same thing. I like the idea of looking at some beaten up ideas that might be worthy in that hot sauce kind of bucket, maybe Europe. Look, I really went down hard on Germany is the sixth man of Europe. And believe me, if you ask Europeans, they'll explain to you what's going on in Germany, and you won't want to hear it in polite company.
Yeah.
What they'll tell you about what's happening. That to me, as an investor, says, so a lot of the bad news might be in those markets, and they're very cheap relative to the U.S. And maybe that, so European stocks as a group, German stocks as a group might be, as a group. Another idea that I like is coming into the beginning of the year, like in November and December, everything I read about the oil market was it's going to go down. Prices are going to go down. And, there's going to be, down, 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 down. And yet, every time I look, it's going up, up, up. Maybe there's something else going there, and that might be worth kind of a speculative play as well too. So these are kind of some of the ideas you want to start thinking about. And if they're too much for you, maybe start thinking about active managers. Maybe not, don't pick the play, pick the manager, and look at some of the active funds. There's hundreds of active ETFs, both equity and fixed, that you could say, well, maybe at this point, throw out a controversial name at you. Maybe it's time to relook at Kathy Wood again. I mean, she was riding high in 2021, and she's had 3 years in the wilderness now. And I've been looking at her performance lately, and it's been pretty good, and no one is noticing. I'm not saying that, that's necessarily an endorsement of her per se, but think about that. If you don't want to invest in these ideas, find people to try and do it for you.
Yeah. Okay. All right. Great. All right. Last lightning round question here. I mentioned briefly you were just at the Double Line conference for Jeff Gunlock's firm with a great panel of other great minds there. Is there anything notable from that experience that you took away of like, oh, that's an interesting point or an interesting way of looking at the world that I didn't have coming in?
Yeah. So next week, the YouTube videos will be released to the whole conference. So they're coming next week in three parts: the macro, the markets, and best ideas. Um, I think that, I mentioned it before. I got it from the Double Line Conference. I didn't realize this, and it was actually a Rosenberg stat that Daniel DiMartino Booth threw out, that so much of the stock market is owned by the older generation.
Mhm.
80% of the stock market is owned by somebody over the age of 55, and that is, and something like 30 to 40% of it is owned by people over the age of 70. That to me was a very telling statistic. as I mentioned before. As far as everything else goes, I think you'll find that there was a range of opinions at the conference, and that's good. You don't want everybody saying the same thing, but I think a lot of the message that I've been talking about in this in this podcast, it will be echoed in those videos when they come out next week.
Okay. All right. Well, folks watching, you'll have a lot. Sounds like next week's going to be a fun week for
Yeah.
you folks, for a lot of good listening. All
In
right.
case you don't want to watch the inauguration, right?
Yeah. I'm lamenting all the questions I didn't have a chance to ask you, Jim, so we'll just have to do it next time. One last quick one. When I interview Stephanie Pomboy, her pet bulldog, Wilhelmina, has kind of become a celebrity because she's always walking around in the video. You've got a cat there who's got some personality. What's your cat's name?
Juliet, and
Juliet.
she is right here. Let me see if I can bring her into the picture. Here she is.
All right.
She's a ragdoll cat. She's 15 years old. She's very old and very set in her ways. You know, so when she wants me to give her something, she just comes up to me and starts biting me. So, you know, hey, she likes to drink cold water. And so when the water's not cold in her bowl, she starts biting me. And it's like, hey,
She,
you're slipping here. You know, let's get going.
she makes sure her butler it's cracking on it.
Right. You know,
All right.
what's the old saying? They say that uh, uh, dogs dogs have masters and cats have servants.
All right. Well, look, fantastic discussion, Jim. I can't thank you enough for giving so much of your time and so many of your insights here. It's been wonderful. For folks that have loved this and would like to follow you and your work in between now and the next time you come on the program, where should they go?
BiancoResearch.com is our research business. That is an institutional business. BiancoAdvisors.com is the index and the ETF that tracks our index. You can find out about it there. WTBN is its symbol. Bianco Research is the on YouTube and on
X.
Twitter, X, and then on LinkedIn, I'm under my name, Jim Bianco. So those are the social media platforms that I operate on. No OnlyFans account yet. I haven't gotten that far.
Okay. Well, you've disappointed a few folks with that, but okay, there's still time, it sounds like. All right, Jim, when I
Or
edit
maybe
this,
I've saved them. Who knows?
when I edit this, I'll put up as many of those links as I can up on the screen.
Okay.
Folks, I'll have them all in the description below the video too, so you can get there with one click. Jim, hold on for 30 seconds. I want to give you the last word here. Just I got to do a quick little housekeeping. One, folks, if you really enjoyed this discussion with Jim, would like to encourage him to come back on as soon as he's got an important update for us. Let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Jim and I have talked an awful lot about his view of what could lie ahead this year. Sounds like at a minimum, his expectations are for a quite different year than we've enjoyed for the past 2 years. If you'd like to get some help in figuring out how to position your portfolio for that, highly recommend that most people watching this video do that under the guidance of a good professional financial advisor, but one that understands and takes into account all the macro issues that Jim has outlined here. If you've got a good one who's doing that for you, great. But if you don't, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. To schedule one of those discussions, just go to thoughtfulmoney.com. And a good reminder, those consultations are totally free. There's no commitment. There's no strings attached. It's just a free public service those firms offer. By the way, when you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the webpage to sign up for our free Substack newsletter. Jim, all right, I want to give you the last bit of parting advice here. You know, as I mentioned earlier, the vast majority of people watching this video are people who are just working hard to build wealth for their families' financial futures. They'd love to prudently grow their wealth over time, but more importantly, they don't want to become collateral damage to, you know, some market correction along the way. Any bit of parting counsel for them?
That you're thinking about it in the right way, and that you want to basically have realistic options. You know, what is the inflation rate? What is the growth rate in the economy? Can my investments do better than that? You're doing well. Your wealth is going to be created by your job, your paycheck, your business. It is not going to be created by a passive portfolio that is going to use the Bitcoin term, moon, you know, beyond your wildest imaginations. Yeah, we all like to win lottery tickets, but not all of us do. But if you invest prudently and just continue to do your job, I think you'll be very happy in the long run.
All right, very well said, Jim. Again, can't thank you again. Thanks so much for giving us so much time today.
Thank you.
All right, everybody else, thanks so much for watching.